Thank you, Peggy. Thank you for the reminder. I'm sorry. I'm going to be recording this session. Appreciate you. Didn't want to lose this valuable content. The Equitable Entrepreneurial Ecosystem was developed and launched this past summer as a response to the COVID-19 impact on small business. The Ppo Freedom Foundation focuses on providing resource support to entrepreneurs and small businesses to help launch them, provide them with the types of tools that will support their development and growth. Due to COVID, we wanted to pivot and to introduce a program that we knew would assist small businesses that were impacted by COVID, especially those businesses in underserved and underrepresented communities. And so we developed a program called E3. And the E3 program works by identifying strategic partners that we assemble to assist and deploy to assist businesses across 5 critical bucket areas of their entrepreneurial life cycle. Those areas are entrepreneurship coaching and business planning, marketing and promotion, information technology and infrastructure, space designation and placement, as well as access to funding resources. And so through this program, we've assembled a number of strategic partners that are ready to assist businesses no matter where they are in their life cycle to help them grow. The Wilmington Alliance, and I'd like to, for those of you who do not know Renata Kowalczyk, she is the CEO of the Wilmington Alliance. She is heading up our implementation. She is our co-lead partner for implementation for Wilmington. We have 3 implementation sites here in 2020. We have Wilmington, we have Dover, and we have Georgetown in Sussex County. Wilmington was first. Renata volunteered to work with us to design the program and be our pilot. And so thank you very much, Renata. We have engaged with 3 small businesses that we are now working with to assist them in their growth by providing the resources that were identified of areas of need when we met with them and discussed their support needs. In addition to having a menu of partners that are ready to support businesses, we also are looking to do education to support entrepreneurs. And that's why we're here today for today's Lunch and Learn. We're excited to welcome our partners and our friends over at Highmark, who are here to talk to you a little bit about the process of choosing the right healthcare plan for your business. Joining us today is their president, Nick Moriello. And with that, I'm going to turn it over to you, Nick, to present today's Lunch and Learn for E3.
Yeah, great. Thanks, Stephen. And for those of you who may not know, I'll share just a quick background. I'm a little more than 2 years into my role here at Highmark, Delaware, but for 25 years prior to joining Highmark, I was an entrepreneur myself. And so entrepreneurship is near and dear to my heart always, and I've kind of taken that vantage point and lens to my work here at Highmark as well. So when Stephen and Renata and Peggy talked to me about this idea, I was enthusiastically happy to try and support and help. I'll share before I dig in to the presentation that we put together some materials that we've had for other presentations for Highmark, but I want to mention up front that by no means do I intend this to be an advertisement for Highmark plans. It's really more I want to share concepts that could be helpful when thinking about health insurance benefits through a newly established business and really kind of what the process looks like. And given that we've got a manageable size group here, I would say at any time, if you have questions, I'm happy to pause and stop and really make this more discussional and conversational versus kind of formally saving questions to the end. So just jump in and interrupt at any time. If a question's top of mind, feel free to type it into the Q&A and chat, or just just chat. I think we have the ability to kind of unmute everybody around the Zoom here. So happy to talk. Pam, if you're displaying this slides, if you could advance for me. Might be having a connectivity issue there. I'll just pause a moment.
Yep. Let's see.
Perfect. And then if you're able to advance to the next slide.
There we go.
Thank you. So something that a general concept, if you haven't established health plans through a business previously, or if you haven't shopped for health insurance plans on your own, the most basic of concepts are all plans fall into two categories. Right? There's employer-sponsored plans and individual or personal plans. And so we'll dig in a little bit today about the major differences between those two and how to go about establishing them. You could jump to the next for me, please. And one more. Thank you. So employer-sponsored plans. So working under an example of you formed a new business, you've got your business plan in place, and you're thinking about, boy, I'm really going to need health insurance benefits for myself and for my family and for employees and workforce that I want to attract and retain at this business. And so in the employer space, there's two basic categories of plans. They really vary based on the size of the business. And some newly formed businesses are going to start in one size category and progress into another category based on your growth plans for employment and the business itself. But they're really based on the number of employees at the business. Regardless of how many people are going to need health insurance benefits, it's how many eligible people are at the business. And so if the business has 50 or fewer employees, that's described as a small business by our federal guidelines that were formed under the Affordable Care Act. The full name was the Patient Protection and Affordable Care Act. Lots of folks refer to it as the ACA, or some refer to it as Obamacare. So this passed in 2010 and became the law of the land effectively in 2014. And it's still the law of the land as it is today. And so for businesses that have anywhere between 1 and 50 employees that want to establish a plan through a business, there's predetermined plans to choose from. And we'll go into a little bit more detail about those. And then if a business is starting right out of the gate with 51 or more employees, then the plans are more customizable and they're based on the needs of the specific business. They're less uniform in that space. So just one other kind of high level difference between the two. In the small group space, prices are based on each individual employee and each individual dependent that employee may want to cover. And so you may have a business with, let's say, 3 employees, just as an example, and there may be a different price for each one of those people because it's based on his or her age. In the larger employer space, there's tiered ratings, and you might be familiar with those if you're already purchasing coverage on your own or have it through an employer. Tiered rating means there's a rate for every single employee, and it's the same for every single employee, regardless of their age or their gender. And then there's a rate for employee and spouse, there's a rate for employee and children, and there's a rate for employee plus spouse plus children, family rate. And so they're tiered that way, those 4 tiers. And every employee in the like category would have the same pricing versus the age-specific pricing in the small employer space. If you could jump next slide for me, thank you. So size is something you don't really have a control over. It is what it is, and you go shopping in that respective market. But when you are shopping and establishing a plan through a business, there's different levers that you can pull that would have an impact on what your price is. So in terms of options, there's fully insured plans, level funded plans, and self-funded plans. And I'll go into a little bit more detail about those in a moment. And then there's benefit designs. Benefit designs mean basically how much you would have to pay when you're seeking medical care. These would be your deductibles, your co-insurance, co-payments, networks, whether a doctor, lab, hospital, or a pharmacy is in your network or out of your network. And some plans come with or without pharmacy coverage as something that we tend to think of, as part of the full package of needs that a person may have. Some plans have prescription coverage and some don't. When they have it, we refer to it as integrated with the medical benefits. If we could jump ahead, thank you. So small employer plans. They are ruled at the federal level by the Affordable Care Act, and the plans are metallic and standardized. Metallic means that the level of things like the deductibles and the copayments are set by the metal level of the plan. So there's bronze, silver, gold, and platinum. They all cover the same things. So in essence, a platinum plan is no better than a bronze plan. They cover the same things, but bronze would have a lower monthly price and a bigger deductible. So when you select the bronze plan, you're saying, I'll cover more of my own medical costs, but I want to pay less every month than my fixed cost of the insurance. And then with PPO plans, with the type of networks, you might be familiar with PPOs and HMOs and EPOs. These basically mean how restrictive is the network of medical providers that you go to. With a PPO plan, you don't have to name a primary care doctor. You don't need referrals to go see specialists. And if you happen to go to a medical provider who isn't in your network, you'd still have access to coverage at a reduced amount. You'd be considered out of network. If you have an EPO plan, it's similar to a PPO in that you don't need to name a primary care doctor. You don't need referrals. But unlike a PPO, there is no coverage if you go to somebody who isn't in your network. So you got to go to the network. And then HMO is the most restrictive in that you have to name a primary care physician as your gatekeeper and always go to that person for your care. And if you need to see a specialist, that primary care doctor has to refer you to that specialist. And everybody has to be in your network. You can't go out of network. Now, I did see Renati posted a question there about the number of employees. That's correct. The calculation of 1 to 50 versus 51 plus, it's the total number of employees or full-time equivalents. It's based on full-time employment. So it doesn't count family members or dependents. It's only the number of full-time equivalent employees. And if you have a business that has part-time employees, their hours count into the calculation as well. So you might have a business with just hypothetically, let's say 3 full-time folks and 20 part-time folks. Those 20 part-time folks might equal 10 full-time folks, so that's how the calculation would work. Thank you for the question. And in terms of, I see another question, in terms of definition of full-time, easiest way to think of it, the employer can set the rules around full-time or part-time based on your business needs. However, from an insurance standpoint, it's generally considered 30 hours. 30 hours a week or more would be considered full-time. Now, an employer can decide to offer benefits to part-time folks if you'd like to. And then the insurer partner would have rules around a minimum number of hours that a person would still have to work to be eligible for the plan. And that differs from one insurance provider to the next. Hopefully that answered the question for you there. In terms of a little bit more detail around PPOs and EPOs. The initials stand for Preferred Provider Organization, PPO. So they're saying we would prefer you to go to these folks, but you could technically go to other folks. Versus Exclusive Provider Organization, where you exclusively have to go to those folks. And then an HMO is a health maintenance organization. We don't have that on the slide because within the Highmark family of plans, we really don't have HMOs anymore. But there are companies that still do offer HMOs, which are health maintenance organizations. So you name the primary care doctor, get the referrals. Couple of other definitions, words, terms, phrases that we wanted to share that might be helpful is health savings plan or health savings account plans. You'll sometimes see these referred to as HSAs. They're one of the most popular types of benefit plans out there for really the last 8 or 9 years. These are plans where you have a lower monthly premium and a bigger deductible. And so you're saying, I'm going to take on more of the cost myself for myself or my family. But because they have a big deductible, the IRS would designate them as a qualified high deductible health plan. And that means you can couple the insurance with a health savings account. And that's a tax preferred type of account where any money you deposit, you can deduct from income. Or if you're depositing it as a business on behalf of your employees, it's a regular business expense and it's not taxable income to the employee. But the idea is the money is set aside, earmarked to be used for medical expenses. So during the course of the year, if you do incur medical expenses that don't satisfy that deductible in insurance, you can use the health savings account to pay those medical bills with tax-free dollars. So it's a tax savings type of vehicle that also can help lower monthly costs, fixed costs related to insurance by putting in that larger deductible. And good question. I see a question about HSA versus FSA, right? So HSA is health savings account. You have to have the qualified high deductible plan in order to be eligible for a health savings account. And when you deposit money into the account, it's tax deductible when you deposit it. And there's no time limit to using the money. You own the money. It sits in a bank account just as it would in a regular savings account. And it carries over year after year. Many accounts also earn interest. And after certain dollar amounts of deposits, you can also choose from investment vehicles. FSAs stand for flexible savings accounts. And you can set those up for as an employer on behalf of your employees, where you pool money on a pre-tax basis from an employee's pay. And then they have access to those dollars for medical plans. Now, the nice things about FSAs, they don't require a high deductible health plan. So you could couple those with any level of deductible. But the bad about those is that if you don't spend the money by the end of the year, it's gone. So you'll hear the phrase, lose it or use it, use it or lose it. And when you have the money deducted from your pay all year long, you have to spend it on medical bills in that year. Otherwise, you lose the dollars. There's a little bit of a carryover provision, but in general, you lose it if you don't spend it. Now, the upside of an FSA, aside from not being married to a big deductible health plan, is that as an employee, you may say, I want to have $100 a month pulled from my pay. You have access to the full year's worth of $1,200 immediately, even if all those pulls haven't happened from your pay yet. Versus in a health savings account, you only have access to whatever you've deposited. So it's just like a regular checking account in that feature. You can only spend what's in there. FSA is like advancing the dollars throughout the year. If we could advance to the next slide, please. Thank you. I won't dig into the details of this slide. This is a listing of all of the plans that Highmark offers within Delaware. So just a bunch of different names that are probably not terribly meaningful for you today, but just to display that a lot of insurance carriers, including Highmark, have a wide variety of deductible size options and copay size options to kind of meet whatever benefit need you might have for your business or for your employees. One phrase I forgot to mention on that previous slide that's referenced here too is shared cost. Shared cost means just what it would imply. You're sharing the cost with the insurance company. So when you go into a hospital, for example, if you have $1,000 deductible followed by 100% coverage, it means you're paying the first $1,000 and the insurance company is paying 100% of whatever the bill is beyond that amount. So you're sharing. And we just call them shared cost plans in our terminology at Highmark, but most insurance carriers use similar terminology. Okay, now this is a concept that, as basic as it might appear, is one that we find our customers sometimes struggle with the most, or even sometimes our consultant partners struggle with the most. And so I'm going to attempt to give you kind of the 30,000 foot simplistic view, but I'm happy to dig into more detail if you like as well. I mentioned earlier that there's a spectrum ranging from fully insured plans to self-insured plans, and there's something in the middle called level funded plans. What these do is fully insured means just like, say, car insurance or homeowners insurance or renters insurance, you're paying a monthly premium to an insurance company, and the insurance company is agreeing to pay your medical bills directly, paying the hospitals, the docs, the pharmacy, etc. So you have full insurance minus whatever deductible or copayment you might have. That's one end of the spectrum. And from a risk standpoint, you don't really have risk in that scenario. You just have to pay your monthly premium. Self-funded is something that the largest employers all regularly do. So I'll use the state of Delaware as an example, as an employer. The state is self-funded, and that means there is no insurance company. The state is paying their employees' medical bills. It looks like insurance because they pay an administrator, in the state's case, both Highmark and our competitor Aetna, to administer the benefits. So they utilize our network of doctors, and to an employee or their family members walking around, they would pay a deductible and copays just like insurance, but instead of the insurance company paying the medical bill is coming from the employer. So the fixed cost in that scenario is just an administrative fee that the employer pays to a third-party administrator, often an insurance company. Their variable cost there is they don't know what the medical bills are going to be for their population of employees ahead of time. Somebody might have a baby, might be an early delivery, right? And they might go to the NICU and the cost could be high. They may have a year where nobody goes to the doctor, so you don't know ahead of time. There's no crystal ball in terms of what that variable cost would be. Now there's a whole field of analytics and actuarial sciences that try and predict what a population will have as expense over the course of a year. And they've gotten extremely detailed and very good at predicting, but nobody has the true crystal ball. For example, nobody would have predicted that we'd be sitting in a pandemic this year, right? So self-funded plans have a level of risk, and the employer is ultimately paying medical bills. This is generally not appropriate for small businesses. This would be appropriate for large businesses that have a very robust revenue stream and could handle unexpected medical expenses. And then hybrid in the middle would say, okay, well, I'm kind of in between, right? So maybe I'm large enough where I want to take on more risk. I want to make my fixed costs less than what a fully insured plan would cost. But I'm not super comfortable with like the sky's the limit in terms of medical bills. So I hire an administrator to handle things, And I also purchase stop loss insurance. Stop loss insurance is, you could think of it as reinsurance, or you could think of it as like a really big deductible. You know, maybe the deductible is $50,000 per incident or $100,000 per incident. Or I say if my bills go over 2 million, I'm out, I'm tapping out, I need an insurance company to help. So you buy a smaller cost insurance plan to protect against that disaster scenario. So that's in the middle, and that's called level funded or hybrid self-funded arrangements. And so just in terms of that risk, again, fully insured is the smallest risk, but the biggest fixed cost. Self-insured is the biggest risk, smallest fixed cost, and in the middle is the hybrid version. I'll pause there for a moment just to check in to say so all of this kind of made sense so far?
You have a question in the chat from Colina. She's saying, so are you saying that the fully insured arrangement, or what? Do you want to expand on that, Colina? Is that the best one for small businesses?
Yeah, fully insured is the most common for small businesses, and hybrids. Hybrids can work for small businesses too, based on how many employees. So one thing I do want to mention that is unique to Delaware, if you're starting a business here, small businesses I mentioned are kind of ruled by the federal rules of the Affordable Care Act, but states had the flexibility to kind of be additive to the federal rules. And Delaware has a unique law that allows small businesses and self-employed businesses to be eligible for group health insurance. So a business could only have one person. You might be starting out, self-employed, open a business, might be planning to have other employees down the road, but initially you don't. A business plan can be set up with as few as one employee here in Delaware. Our neighboring states do not allow for that. So that's a nice feature of the Delaware landscape here. Okay, so I wanted to share just a little bit of details of some of the things as we see from Highmark lens. Again, really not to be a commercial for Highmark here, but we have the largest market share in the state, so some of these numbers may be relevant. As a small business, we have roughly 2,800 small businesses around the state, and that population totals about 21,000 people. Those are fully insured plans, and an advantage that a small business has is you're not priced based on your own experience. So you think about car insurance, you have an accident, you know, it factors into your prices. In medical claims, we don't want a scenario where a small business has a large medical claim and next year you get a 200% price increase, you know? So the pricing is set over this entire population of 21,000 people. And so the rates either go up or down cumulatively for the whole population. So you can almost think of it as the buying power of a bigger business because you're joining a population of all the small businesses together. And so this population has really been having good experience in recent years. And we've had a lot of levers that we've pulled as an insurance company to try and help our members here best manage their costs, seek care at the right time, at the right place, at the right price. And that has resulted in our prices for 2021 are going down by 3% at a time when a lot of pricing is going up. And this year, during the pandemic, even though it's a health crisis, it's actually led to less claims than normally would happen because there's a lot of folks, particularly at the beginning of lockdown, where they weren't going out for care. So if you didn't have COVID, you weren't seeking, you know, a hip replacement or a knee replacement or kind of, I'm going to say, non-essential health benefits that weren't emergencies. And so we've experienced less claims than we normally would have expected this year. And that prompted us to just give all of the small and large businesses who are fully insured the month of December for free. So we waived the premiums for those folks. I see another question in the chat. Let me pause for a moment to digest that. Okay, so someone is asking about association-based plans, such as the Newcastle County Chamber of Commerce. So Delaware law at the moment does not really allow for what I'm going to call full association plans. So that smaller business with the buying power of bigger business, it kind of only happens by joining an existing fully insured pool of people, like our population here that has the 21,000. Other associations that offer benefits, which there are several, inclusive of Newcastle County Chamber, as the question points out, really are a purchasing channel for businesses to buy the same kind of plans that the business could buy on their own, directly working with an insurance company. So there's not really a pricing differential. It's really a service model difference. So some may say, I want to have my plan serviced through a Chamber of Commerce. But in terms of the pricing and the plan designs and what's covered versus what's not covered, it's the same. There's not a difference there. Now, true association plans don't really exist here in Delaware today, and the law is prohibitive of them at the moment. But in other states, which I think is part of the question as well, in other states that allow association health plans, basically the association plan stands as its own risk pool. That can be good or it can be bad based on the population of that particular association. In a small state like Delaware, now I'll take off my Highmark hat. This is a Nick opinion, not a Highmark opinion. In a small state like Delaware, association plans can be challenging because our population is just not that big. And so if we had, let's say, 3 or 4 association plans and also a fully insured population, all competing for business, competition's good. However, a likely outcome is one of those populations will probably have better experience than the other. And it'll draw folks to that one. And that one will end up with a good pricing structure. And the worst risk will remain in the other. And the other will go into what we have a not so nice technical term of death spiral. The price will just spin out of control for those folks. So as much as I am a fan of competition and pro-market dynamics, in a small market, it's difficult to introduce too many different options like that. So that's one of the reasons why our law has not permitted full association plans to the extent that some larger states have today. Let me take a breather there and ask Sandy, did that answer the question? All right, not seeing a head nod there. I'm going to kind of assume yes and trudge forward, but feel free to jump back in if I didn't. So in terms of options within our portfolio of plans, we do offer that full spectrum of level funded, self-funded, and fully insured. But we have some rules to try and protect small businesses too. So our level funded plans, we only go down to businesses of 15 or more employees. But below 15, and it's kind of our belief that the risk is too great for having that level of risk. So our thought would be in a business of 1 to 15, fully insured is most likely the way that you would want to go. Above that is when you start looking at those other options. I do see 2 questions there. Go
No, I was just going to point that out. Two folks, both Sandy and Colina, have the same question.
Yep. So thinking about most cost effective for business with less than 10. Two things I'll say there. One, fully insured is the kind of general direction that you would want to look at. Two, you're going to want to consider both small business plans and individual plans, which we're going to go into in a moment. And then perhaps my biggest words of recommendation would be, you're going to want to work with a broker or a consultant. Where brokers or consultants can help is they act as an advocate on your behalf when you're shopping, and they don't have a bias towards one plan or another plan, or one insurance company versus another insurance company. They're acting on your behalf in that scenario as a no-cost additive to you. And so the compensation for brokers or consultants are baked into the costs that insurance companies have. So you don't pay extra to work with a broker. You don't save if you don't work with a broker. So that's a big part of my past history. So another near and dear to my heart, in addition to entrepreneurism, is work with a broker or consultant, because they can look at your unique needs and kind of help guide in terms of direction. I think we'll talk about that a little bit towards the end of the presentation as well. I'm just reading the other questions there.
Yes, Nick, we will be sharing a slide at the conclusion of the presentation with a couple of brokers that we have experience with and have worked with. So, and we'll also be sending that out to everyone.
Wonderful. Great. All right, if we can jump to the next slide. And I think the other questions that I see in the chat there are kind of around that broker topic. So I'm going to pause on those and come back to those. That's it. Perfect. I forgot this was the next slide. So that was kind of perfect timing there. So insurance brokers, they act as an intermediary and kind of act on your behalf. And they don't represent the insurance company. So that means they can't bind coverage. If you give a payment to a broker, your coverage is not active as of that moment the way it may be in other types of insurance. You generally have to get that payment into the insurance carrier's hand. There's a couple exceptions to that rule, but in general. But I do highly encourage you to look to brokers for assistance, because they can kind of help navigate. Now, some brokers specialize in group health plans. Some have arrangements. You mentioned Newcastle County Chamber as an example, with specific brokerages, which I think are one of the ones we're going to mention here in a little bit. And there's a lot of brokers throughout the state as well. So that's something I can't make a recommendation around. We work with all the brokers in the state, being the large insurer here, but wanted to mention that there's a lot of folks out there. Some specialize in employer plans, some specialize in individual plans, some do both. So you may want to ask those questions as well if you are shopping for a broker partner in your business. If you could jump ahead for me, please. So individual plans. Individual plans are different. These you do not buy through your business. These you buy directly from an insurance company, the same you would, let's say, your personal car insurance or personal home or renter's insurance. These plans are also standardized under the Affordable Care Act, and they're metallic, just like the small business plans, bronze, silver, gold, platinum. And every year, happens to be right now, every year from November 1st through December 15th, folks can shop and buy a different plan for the upcoming calendar year. And so we encourage folks who currently have personal insurance to get in the habit of every year during this window of time, reevaluating, because your circumstances might have changed. The prices might have changed. And you want to make sure you're in the best plan for you every year. And it's a pain in the butt to go through that every year. And folks that are change adverse may not want to make changes every year. You might have a plan you're really happy with, but it might be changing. The price may change, the deductibles may change. It's something you really need to evaluate every year during this specific window of time. Now, there are also special enrollment periods. So a common example for a new entrepreneur, you may be working for a large business. You may have health benefits through that business. You're deciding to take that leap and go out onto your own and open a business. Losing coverage through an employer creates a special enrollment period for you. And that gives you a 60-day window to buy insurance right then and there. It doesn't have to be during this annual time period. But then moving forward, you'd have that annual time period to re-review and make changes. So if you lose coverage for any reason, you go through a divorce and lose coverage, you leave a job and lose coverage, you moved from one state to another state, the plan you had in the previous state didn't transition to here, a loss of coverage creates one of those enrollments. Getting married, having a child, those things create special enrollments as well. If you could jump to the next page for me here. So essential health benefits. I won't drain this slide, but you'll have this for reference. Basically, under the Affordable Care Act, it says every plan, bronze, silver, gold, platinum, has to cover all of these things. They have to be included with the plan. And some of them are included at no cost. For example, preventative visits, and it's a finite list of what's defined as preventative, but preventative visits are free. It doesn't matter if you have a deductible or not, just as an example. You can jump ahead. I won't drain this either, but these are some of the additives that we put into our plans as Highmark. You jump ahead there for me. One more, sure, thanks. So here you just see it laid out a little differently, but it's the same bronze, silver, gold, platinum with one addition. Individual plans also have something called catastrophic. Catastrophic is the least expensive of the metal levels, and it has the largest of the deductibles. But you can only buy these plans if you're a person under the age of 30 or if you're experiencing a financial hardship. So that's a federal rule, not a Delaware rule. So it's a limited audience for the catastrophic plans. If you could jump ahead, thank you. Now, the major difference between personal plans and business plans. Personal plans offer financial assistance at the federal level. So when you're first starting out, you may not have revenue coming in through your business yet, or it might have limited revenue coming in through a business. When you're shopping for a personal plan, the process involves you estimating what you think you're going to make over the next year. And if it falls below 400% of the federal poverty level, there's governmental assistance to purchase the plans. And there's two forms of assistance. One is advanced premium tax credits. That's the federal government giving you a tax credit, but advancing it to the insurance company, and the insurance company takes it off your monthly premium. So easy math, you have a $300 a month premium, you get a $200 a month tax credit, you only get a bill from the insurance company for $100 every month. But at the end of the year, come tax time, when you're filing your personal tax return, there's a reconciliation that occurs where basically the government says, hey, you told us you were going to make $40,000. What did you actually make? And odds are you didn't hit it on the head, to the penny. So maybe you made 50 grand. Business did better than you thought. They'll say, okay, that's wonderful. Congratulations. However, we gave you a tax credit based on 40 and you made more than that. You owe us money back now for the difference of whatever the tax credit would have been at 50 grand. Conversely, maybe you only made 30. They say, we should have given you more. Here's a refund. So you get a refund check at tax time for the extra tax credit that you could have received. And if your projected income goes below a lower threshold, then you qualify for Medicaid. And Medicaid is a state insurance program that's free. There's no charge. So when you go through the shopping process, it'll evaluate that and help you. This is done through the federal marketplace, which is healthcare.gov. And brokers can help with this component as well. And so can insurance companies if you contact them directly. In this case, I can be a little bit of a Highmark commercial because we're the only carrier in Delaware for this. So there's not another option. So you're welcome to come to us if you need help with that. The second type of governmental assistance is cost sharing reductions. So for folks who fall somewhere between the federal poverty level and the 400%, in addition to the tax credits, you might qualify for something called cost sharing. Cost sharing is married to a silver level plan specifically. And it says, if you qualify for cost sharing, in addition to paying monthly tax credits to the insurance company to lower your premium, the federal government will also send money to lower your deductible and lower your co-payments and your cost sharing. So those can be really beneficial when you qualify for those. So one of the things we see in practical day-to-day practice, somebody goes into a new business, entrepreneurial efforts, opens up a new business, doesn't really have employees yet, but is hitting the ground running, leaving another corporation, losing benefits. They may buy a personal plan, get some governmental assistance with help. Business starts generating revenue, hiring more employees, then set up a group health insurance plan through the business and transition at that point. Any insurance plan you establish, an employer plan or a personal plan, can be canceled at any time. It's like there's no long-term contracts with these things. So you can transition from one plan to the next during any particular year if you wanted to. You could jump ahead. This just gives you examples of the dollar amounts of where you qualify for different types of assistance. Again, we'll send this out so you have this. Jump ahead. I do want to mention briefly short-term health plans because there has been some confusion in the market about these. There are a list of insurance companies that sell short-term health plans. These were designed to bridge the gap between coverage. So easiest historical example is you go from employer A to employer B, and employer B says, once you worked for us for 60 days, you're eligible for health insurance benefits. And so you really just need something for the 60 days from when your other employer plan ended to when your new employer plan started. So you can buy a really lean policy that says, I'm just worried about if I have some disaster happen over these next 60 days. Low monthly premium, very, very low fixed cost, one-time type of payment, but very, very basic coverage, not regulated by the Affordable Care Act. So there's no essential health benefits. There's no maternity coverage. There's generally no prescription coverage. These are very basic plans. They're not bad if you go into them eyes wide open with what they are. Unfortunately, there are some practices out there where these plans are sold as if they are more robust coverage for long term. So sometimes a challenge we see in a new entrepreneurial effort is somebody may come to us and it's, let's say, 7-8 months into their business. They bought one of these plans because it was affordable. They didn't know the full spectrum of what was available. They weren't viewing it as a temporary plan. And then they had a health event and it didn't cover the event the way they thought it was going to cover the event. And now they're saying, uh-oh, now I need insurance. But there's no special event now. You're not losing insurance. You can't buy it now. You got to wait till the next open enrollment, or you don't have the business established to set it up through the business because now you're dealing with a health issue. So these can be risky. And so you really want them, if you view the need to be a limited time window type of need. You could go ahead. One more. Thank you. Networks. When you're shopping, it's critical that you look at the network of whatever insurance company you're considering. And whether you're considering an EPO, an HMO, a PPO, you want to make sure that the medical providers who are important to you or who would be important to your prospective or current employees, you want to make sure the network has those folks in there. Bragging point, Highmark land here, our network is enormous. We have most of the providers that you can think of in our national network. You can jump ahead. Go ahead, we talked through that. On our personal plans, we've added some dental and vision benefits. A lot of plans don't automatically include those things. So that's something else you should ask in the shopping process is, do you want to have dental benefits? Do you want to have vision benefits? Do you want to offer these things to employees? You might have been entering a business space that's highly competitive, and you may be competing against large employers that traditionally have all of these things. And so if you're going to try and attract the best talent to come work with you, you may have to have these things, even if you personally don't need these things. So something else to consider. And how can you learn more? We have folks available if you need our help. So we'll give you those details and then jump ahead. And I don't think we have it in our presentation, Stephen, but you have some broker partners that you want to mention who you've worked with.
Yes, so let me share that really quickly. Can everyone see this?
Yep.
Okay, so here is a list of healthcare and insurance broker partners that we and various partners of ours have engaged with. I personally have just gone through this process for the Ppo Freedom Foundation and utilized one of these partners here as well. So, we'll send this out to everybody so that you have this in conjunction with the presentation and a link to the recording from this meeting. But here's the list that we compiled that we can send to you as well. There's a question from Sandy in the chat, asks to speak to the difference for Delaware plans that are limited to in-state coverage or multi-state.
Yeah, thank you for that question, Sandy. So kind of a Highmark sales pitch here. All of our plans are national plans. So they tap into the Blue Cross Blue Shield Association network, which we call Blue Card. So none of the Highmark plans are limited to Delaware only. Additionally, under Affordable Care Act rules for small businesses and individuals, regardless of the insurance company, emergencies would be covered nationwide. In our plans, we cover kind of everything nationwide. So there's not a restrictive network that would say you have to receive the care in Delaware. You may establish a business in Delaware and perhaps you live over a state line in, say, New Jersey, Pennsylvania, or Maryland. If you're establishing it through the business, it's based on where the business is domiciled. If you're buying a personal plan, it's based on the plans available in your resident zip code. So I'm glad you asked that question. It triggered that thought in my mind.
Great. Do we have any other questions from anyone in attendance?
Okay. Awesome. Well, hey, thank you for inviting me today. I'm happy to share. If there's anything we can do to be of assistance as you make this journey into self-employed, sole proprietor, new business world, happy to help in any way that we can. Think of me as a resource. Again, I'm happy to connect about any kind of questions and be part of that journey with you.
Okay. Really quickly, Sandy just wanted to confirm, so business plans in Delaware are also multi-state with Highmark.
Yes.
Okay, great. Thank you, Nick. Thank you so much to Nick and to our friends over at Highmark for presenting this information. Thank you, everybody, for attending our E3 Lunch and Learn, and be on the lookout for more information sessions coming in the future on timely information that will support our entrepreneurs. We appreciate everybody joining in. And if you want to learn more about the Equitable Entrepreneurial Ecosystem Program, please visit the Pete DuPont Freedom Foundation website at www.PeteDuPontFreedomFoundation.org/E3. Thank you, everybody, for joining, and we wish you a good rest of the day.
Thank you. See you.
Take care.